the two bond funds inside your thrift savings plan have completely different characteristics. When looking at them separately, it's easy to miss when you should overweight one over the other. In this episode, we're going to compare them side by side so you can see when one outshines the other. We will also look at how you can maximize your overall allocation using bonds and provide some tips so you can build your TSP bond allocation. Welcome. I'm Ed Smith, President of Valor Wealth Partners, where we're dedicated to educating federal employees on how to maximize value from your complex and often underutilized benefits. I'm really excited about today's video because I like to be able to talk about different funds that sometimes people aren't using and using together. And today we're going to be looking at the two bond funds inside your TSP, the G and the F. And while it might seem like I have a favorite of those two bond funds from my previous videos, and in reality, I don't. I want to be able to make sure you're using them together to maximize your best benefits for you of what you want to be able to get out of the TSP. And when you're looking at overweighting your portfolio, one fund over the other, the key word really is about overweighting. You should have a combination between the two versus all in on one of those two funds. If you haven't looked at one of the videos before on the G fund, and there's a link above, or on the F fund, you can use this link, I do recommend you going watching them first because I really get into the details of those two funds, and today we're really going to be comparing them together. So I really do suggest you look at them, and hopefully they'll be able to help you out when you're looking at them. So let's dig into the performance because that's what everybody wants to see. And if you've already got the specifics of the funds, we don't have to spend so much time on them. From the other videos, you probably have already gone to the TSP.gov website to look at the performance of the funds individually. So let's look at these together, and here they are. When we're looking at these old long-term portfolios, again, the lifetime, the G fund has a 4.75%, and the F fund has a 6.03. Now, this is mid-September in 2021, so they may have changed, and they do change from time over time, but we want to be able to look at this. So as you can see, the F fund on a long-term basis is about 1.25 better per year than the G fund. And there is a little bit of time of difference between when they started. So we always want to put the since inception date so you can actually see what those numbers are. So it's nice to be able to look at what the long-term benefits are in one versus another. But really, what does this mean? And how does this affect you? One of the tools I use as a financial advisor is what's called the Rule of 72. Now, the Rule of 72 is something that you can see to how long it takes for a certain rate of return to double on a different investment. So let's look at this. On the Rule of 72, if you had, for example, a 10% rate of return, that would mean that the account would double in 7.2 years. And vice versa. So a 7.2% rate of return would double in 10 years. When we're looking at the G fund and the F fund, based off those two rates of return on the lifetime numbers that I just shared with you, this means that the G fund would take 15 years roughly to double. And the F fund would be about 12 years. So when you look at these numbers and you actually drill down to the percentages, it's about 3.25 years difference for doubling. But really, does this really matter? 3.25 years, how much of a difference is this? Well, when you look at a bigger term, that actually can make a big difference. So let's look at the G fund as far as the G fund expanding over multiple years, let's say about 45 years. When we're looking at this number, we see different numbers here. You take $100,000 in the G fund at, say, age 35, and by the time you're 80, you have $800,000. That's a great return on the G fund. Now, again, we're not taking into consideration inflation or any of that type of stuff here. We're just looking at the pure value of the account. And again, it's simplicity here using that simple rule of 72. While this might seem like a good number, if you look at the F fund and just 3 years later, going from 80 to 83, you would have doubled one more time because those 3.25 years actually taken over a longer period of time, they give you a whole nother time to double, which means you would actually have $1.6 million versus $800,000 that you would have in the G fund. This is a big difference. Now, for some of you later on in retirement, maybe you're not looking at 50 years. And even if you're at 35, you're like, geez, 50 years is a long time away. But in reality, you're not looking to get to retirement, you're looking to get through retirement, and maybe you're even looking at passing on some of this money to your heirs. So you have to be able to look at the long-term nature of an investment and what that will mean for you and for your family in a longer period of time. So 50 years or 45 years is a good long-term period of time to be able to look at it. And you can really see the difference of what a couple of percent will make over those long period of time. Okay, we're back on the TSP.gov website, just like we were with the G fund and the F fund. Since we've been talking about performance already and talking about the rule of 72, let's go right into fund performance and see what they are for these two as we compare them. Again, we want to deselect everything and then just select the G and the F. Now, there is a little problem with the website. I found that they bring up the index even though you're not asking for it. So we're going to select it and then deselect it specifically. And these will just allow us to compare them without any clouding it with the index that the F fund has. As you can see, different periods of time, and then monthly rates of return, and then annually. But what I really want to focus on is the visual aspects of what this means. Now, the G fund is in the orange, and the F fund is in the more of the maroonish type of color. As you can see, the F fund is a lot more erratic, and these are annual periods of times. We also want to point out when we're looking at this that there were 4 periods or 4 years when the F fund was negative. Now, I am including the current year, even though I know it is not a full year, and we're only looking at year to date, again, mid-September in 2021, but I do want to be able to show it because we're still 0.5% down. While this can change before the end of the year, I want to be able to include this. But all of these periods of times when you were negative, if you had a 50% F fund and 50% G, you most likely would have had a positive rate of return in all one of those years. Lower returns on some of the other ones. And so that's something you want to be able to look at is by combining these funds, you actually might find a good balance between volatility and better yields. The next thing I want to look at is a monthly rate of returns. And when you look at this, the F fund is all over the place where the G fund is a very flat number. While going down, it's very flat. The F fund is just so much movement here and a lot more periods than it's negative. So if you're going to be looking at your TSP on a monthly basis or even a shorter period of time, you're going to see a lot more movement in the F fund. I generally suggest not being that granular and watching it all the time because it is a long-term vehicle. Now, let's go back up to the top because I want to go back to a couple of points when we're looking at the funds specifically and just want to point out where to be able to look at this and how you can look at them and compare them. All right, take the C and the I over there, bring the J, so you just have the G and the F, and we can compare them. And now we're side by side. The same way that we did them as individuals, we can look at them and compare them together. So again, objective, rates of return, risk, we know it's low on the G, low to medium on the F. Now the total expense ratio, you're just about 0.05 on the G and 0.06 on the F. There isn't too much of a difference, but if you want to say that the F fund is more expensive, yes, it technically is, but this is an extremely low expense ratio compared to most of the funds out there in the bond universe. All right. You can also click to learn more if you want to go specifically back into them. We've already done this, so you don't have to do it again, but it's just something that you can be able to look at if you want to be comparing them. Now that we've taken a good look at the TSP.gov website, let's go back and look at your overall portfolio and see where bonds fit in to the big picture. For most people, you shouldn't be relying on the TSP as your only asset. You really have to have other assets outside of the TSP, and bonds can play a very good part. So if you're using bonds in different types of portfolios or different types of accounts in your overall portfolio, it will affect how your TSP reacts to the other investments you have. So let's take a look at this. First off, why would you use bonds in a long-term nature if we've already showed you that the rule of 72 means you want to have a higher rate of return so your money can double quicker? Well, first off, not everybody is comfortable with volatility, and this is perfectly okay. Don't try to get into this very aggressive nature or greed trying to get a higher rate of return. You have to look at your emotional side, and if having less volatility, meaning more bonds, that may be a very good thing for you. Again, everybody has their own comfort level, and bonds might be yours. It's just looking at how we are using them in your overall portfolio. When we're looking at different types of bonds and different types of accounts, let's take a quick summary of those different types of accounts and the tax ramifications for you. When you're looking at your traditional TSP or traditional IRA, you don't pay taxes today, but you will pay taxes on both the principal and the growth of that money. In your Roth TSP or Roth IRA, you will have to pay the taxes today, but you will not have to pay taxes on the principal because you've already paid it, and you will not have to pay taxes on the growth, which is a huge benefit of using a Roth. The final type of account is not a retirement account. It's a non-retirement account, or typically called a non-qualified account. In this type of account, you pay the taxes today, but you could also pay the taxes on the growth of that portfolio. Now, some types of investments will have better tax favoring than others, and even some types of bond portfolios, you never have to pay taxes on the interest you earn. So there's benefits of each one of those different types of accounts, and it's how to position them for you. When you're looking at the different types of investments to put in those accounts, in a traditional account or traditional IRA type of account, you would be looking at some type of a bond portfolio that would be a general nature of that bond, because it's not going to be growing up that much, which means the taxes will be less. In the Roth type of accounts, you'd be looking at like a high yield bond where you're trying to get a higher return on that type of account, and maybe even equities in a Roth type of account to get that higher rate of return because you don't have to pay taxes. And that final, the non-retirement, this is where you might want to use municipal bonds, which are tax-free on the interest that you earn. You also might have tax favorable status on a capital gains of other types of investments as well, which could be better than your marginal rates. So the types of accounts are very important, and this is the big picture of what you want to be able to look at. When you're looking at the overall portfolio, some of your accounts are short-term and some of them are long-term. Your TSP is the long-term account. The short-term accounts are where you'd have emergency reserves or money that you're planning to spend in a short-term period to be able to spend on different things that are coming up. Maybe buying a house. Maybe it's looking at the first couple years of retirement. Whatever it is for you, you want to categorize the types of accounts and the investments to match. And so just I was talking about before, where the different types of bonds could fit into different types of accounts based off of tax status, you also have to look at the right types of bonds for the right types of accounts. And then when you're looking at the TSP, if you're using the G fund, that's a short-term investment because of the low volatility. An investment like the G fund, now I know you can't get the G fund outside of the TSP, but an investment similar to that might be more appropriate outside the TSP than inside the TSP. Now this doesn't mean to take it completely out. What I'm saying is that you want to be appropriate for the right types of investments, for the right types of accounts, and the right types of needs that you're going to have. Now that we've given a quick summary of the overall portfolio and how bonds fit into the big picture, let's get back to the TSP. When you know what the overall allocation should be in bonds, now you want to try to be able to figure out what the best allocation inside your TSP should be. One of the first places people look at are the life cycle funds. And for me, I completely disagree, especially later on in life. Early on, it might be okay, but here's a summary and the picture of what it looks like on the life cycle funds with the allocation changes over years. As you can see, the G is heavily overweighting the F. And because the TSP is a long-term account, you want to try to get a better rate of return if you feel comfortable in that area. So generally just defaulting to the life cycle funds, in my opinion, is very bad. You want to have a good mix based off of what is best for you. I talk about this over and over again. Another thing I talk about is trying to get an appropriate risk allocation to you so you know what this is. There's a lot of tools out there, and again, we're going to share the one that we use in the description section so you can be able to use that for free if you want to take a risk assessment test. Let's look at the tips for overweighting the G versus the F fund. Now, these can be very helpful for you when you're trying to design the portfolio that best fits for you inside the TSP. Let's go right to the G fund. You want to look at the G fund when you're looking at a period of rising interest rates. Typically, this has been better in that scenario. You also want to look at the G fund when you have an emotional fear of the future and you're concerned about the markets and you just want a safety level. The G fund will provide a really good safety blanket knowing that there's very little volatility in the overall fund. And the last area is when you want to spend everything in the short term. Now, we talked about the TSP being a long-term investment vehicle, but there are times when the TSP will be a short-term account, and this could be right before retirement and you're trying to get to a couple of years for one reason or another. Now, let's look at the F fund because that has areas when you might want to overweight as well. Just the difference from the G fund, when you have falling interest rates, you would probably want to be looking at the F fund because statistically that is outperformed in those areas. Also, when you can emotionally handle the bumps or the volatility from the overall market and you're trying to get a better rate of return. And finally, when you desire a higher long-term real rate of return. Now, we discussed the real rate of returns in the G fund video. So if you need a little bit of help looking at that, we have some good resources in that video that talk about the real rate of return. But realistically, on the F fund, when you're trying to get a good long-term rates of return over and above the G fund, you want to, but that doesn't mean the F fund is always the best vehicle for you. If you're still watching today, please hit that like button so we know that this content was good for you. And always, if you have a comment or you have a point that you want to make, please put it there so we can see your perspective, because we also learn from the people that are watching these videos and we want to provide the best information for you. In summary, the G and the F funds are both good funds. Hopefully today you've got some insight of when you should overweight one over the other. You also probably got some insight as to when you should be looking at reducing the amount of both the G and the F fund in your overall TSP portfolio, because you might be able to use different tax strategies or be using another type of account for your short-term or emergency type of reserves. As always, we want the best for you and your family, so please get unbiased, conflict-free advice. Thank you for your time today, and we look forward to helping you in the next video.